Hello, everybody, and welcome to the ISTAT Learning Lab. Today we have Marianne Riggi in the studio in New York, and she's going to talk about airline and aircraft-backed bond ratings. Marianne is the head of Kroll's transportation and commercial finance ratings. And she has 25 years of experience of credit analysis in banks and specialty finance companies. She initiated Kroll's lessor ratings in 2013 and is responsible for the analytical framework and the rating franchise for all transportation within Kroll. Before Kroll, Marianne was with Moody's and led their bank and financial institution department. And before that, she was with the Federal Reserve Bank of New York and was there as a banking analyst. Marianne has a Master's of International Affairs and Finance from Columbia University and a Bachelor of Arts in Linguistics from the University of Kansas. Before I hand over to Marianne, I wanted to just mention that if you want to make her slides bigger, you can just click in the corner of the frame and drag it and enlarge it. You can also post questions during Marianne's presentation in writing by clicking on the little circular button at the bottom of your screen with two call-out bubbles. You can write in the questions there, and then after her presentation, I will go over the questions with her. Also, remember that on the 25th of September, we have Shannon Ackett from Jackson Square with us to talk about aircraft and engine maintenance. And then on the 29th of September, we have Ronan Doyle from Price Waterhouse to talk about lessor accounting in times of crisis. And we are planning on continuing with learning labs through October, November, December, and details will be available on ISTAT's website in the next few weeks. All right, so now over to Marianne in New York.
Hello, everyone. And thank you, Nils, for the introduction. And looking forward to today's session. So I think that everyone has the slides in front of them, and you know who I am. Nils gave me a very nice intro. So why don't we go to the first slide? I just put this in a more, like in this circular slide, just to make it a little bit clear to understand and to follow more on a conversational basis. So just so you know, we rate numerous types of financings in aviation vertical. In fact, we've become one of the biggest names in aviation since only 2013 with our first rating, which was rating of Airlines Corporation. Soon after that, we rated our first ABS transaction, and then followed by that, we rate now something like 7 public leasing companies, and then plus 2 which are rated privately. We also rate more than 105 transactions that are either secured aircraft transactions or WTCs, and they could be backed by leases to airlines or just straight lessor-backed transactions that are backed by aircraft also. But we also assign unsecured ratings to leasing companies and all kinds of transportation companies, which may relate to aviation or not. Just to say, just so you understand where we are in terms of our ratings. On the ABS side, we've rated more than like 60, 70 transactions. Now the ABS market, of course, is very slow given the crisis, but on the corporate side, meaning the non-ABS side, actually things have been very busy, and the reason for that being that in the post-pandemic world, or in the middle of pandemic world, let's say, there's been a lot of need for financing, so most airlines have been trying to tap the capital markets to the extent they can. That's in addition to the government care supports that they've gotten around the world, but they've been very, I would say, creative actually in trying to get financing. whether by using, say, leaseback transactions or even using their intangible assets, which I will go through a little bit later. But just going back to this slide, you can see that I've just laid out the various types of financing. So we have WTCs. I think that you probably all know what those are. They're enhanced equipment trust certificates, and they're very commonly done for very large airlines because you need at least a relatively, not maybe large, but a relatively large pool of aircraft, let's say more than 8 or 9, in order to have a deal like that done that's effective in terms of your financing. They've changed a lot in terms of their structures throughout the years, especially post-crisis. And now what's really interesting about the WTCs, more importantly, is that you can have an airline that's rated at a very low rating, let's say a single B, but you can achieve a much higher rating for the WTC. And the reason for that being that they benefit from either Cape Town legal framework or 1110, which is the part of the US bankruptcy code that these deals operate in. And really, to just summarize that from the perspective of rating, what matters is that this kind of legal framework allows an airline to actually be in restructuring or bankruptcy outside of liquidation, yet still affirm the pool of aircraft that are in their WTCs. And the reason for that being is that WTCs in general will be deemed strategic to an airline. And I will go through what's happened recently with a Latin American airline where they actually rejected their WTC, and that's been, it's actually been an interesting trend in the market, and it's been quite controversial. We can talk about it a little bit later. But in general, WTCs are deemed to be strategic to an airline, meaning that the airline will support those leases even if they're in bankruptcy, meaning that operating those aircrafts are very critical for them, even if they are in bankruptcy. Of course, now, we're in a very different situation because of COVID. It's hard to see what's strategic because many airlines cannot even fly. And 80% of the aircraft are actually on the ground, if not more of them globally. But just to try to say that, so that's one form of financing. It's traditionally been done for larger airlines, I would say, and in jurisdictions which will allow this kind of legal framework. Most of the financing, though, which I'm not going to talk about because it's not relevant to rating for airlines, are done by banks. So WTCs and all these other, I would say, capital market types of financing still make up a smaller portion of financing for airlines. And now we're totally in a different environment, so we'll have to see how that pans out in a post-COVID environment. So the kinds of WTCs that you see, because these are the kinds of financing that are allowed under these kinds of legal frameworks of Cape Town or 1110 of the US. It could be aircraft assets, it could be engine-backed assets, and there are a number of other aviation assets that could be involved too. But most of the time, they're either aircraft or engines. And at Kroll, we've rated aircraft WTCs as well. We've also rated engine WTCs, which again, you need a lot of engines to be able to do one of those. But these are all available to airlines who have the unencumbered assets to do that. So the other part of the market clearly are the leasing companies. So these are, let's say, around 40 to 45% of global fleets that are owned by leasing companies versus airlines. So they make up a very big part of the financing. And leasing companies are actually financing companies because essentially what they're doing by renting aircraft to airlines, essentially they're financing aircraft for airlines. So therefore they need their own access to capital. In fact, it's very critical for them. And leasing companies have in fact, become a lot more prominent in the past few years because, they provide a lot of liquidity for airlines. So airlines don't have to own aircraft and not have residual value risk because that risk is taken by the leasing companies. So leasing companies are very, very important for airlines, especially for airlines who don't have a lot of access to financing so that they can buy their own aircraft. So for example, in the US, where before the crisis, you had pretty big airlines, and given that they had gone through rounds of restructurings and that they had delevered and had strengthened their balance sheets, there wasn't a huge amount of need for them to lease aircraft, at least not the large ones. So you would see that the global aircraft leasing companies' portfolios are not really in the US, only maybe up to 10%, not even that much of their aircraft are leased in the US. It's usually in the rest of the world, and they tend to be leased to smaller airlines or, flag carriers in smaller countries, perhaps. So with that said, the kinds of financing that the leasing companies do could be either senior unsecured, which is essentially a senior unsecured financing for corporate purposes, and they're not directly backed by aircraft, but they're backed by the credit worthiness of the leasing company itself. And most leasing companies have actually moved toward that model in the past few years, which has benefited them a lot, in fact, during the crisis, because having a more unencumbered asset portfolio gives you a lot of liquidity. That means you have aircraft to be able to post as collateral to gain liquidity in the markets. And that's been, I would say, been very thoughtful on their part to have this model, because it was exactly for this type of market that they needed it. And that's why you see that globally, most aircraft leasing companies are having a lot less trouble with credit than airlines do. And that's mainly because of their stronger liquidity. But leasing companies do also do some aircraft-backed secured debt. And those tend to be leasing companies that may not have very good access to the unsecured markets. And that could be because they're smaller. It could be because their credit metrics are not strong enough to be able to get good financing rates on senior unsecured bonds, which tend to have a higher rate than secured deals. But I would say that given the consolidation in the sector, given that you have much bigger names, but let's say, you have a concentration on the stronger, bigger names of leasing companies globally. We were going through a process where a lot of the leasing companies tried very, very hard in the past few years to try to become investment grade, because that was really helping them to be able to finance in the unsecured markets, and they were able to do so. Just to say that from our perspective, given what's going on with COVID, of course, we have a negative outlook on the sector because I think the reasons are clear. There's lots of aircraft on the ground. Aircraft are leased to airlines who are not able to pay, and they're asking for deferrals. And some leasing companies have actually been able to help their airline customers to be able to do that, at least in the short term, until we get over the crisis. And they've used it in some ways as negotiating tactics to try to have better deals with the airlines later on. In the past, leasing companies also did a lot of asset-backed financing in the ABS market, which is different from the corporate markets that we're talking about here. But because they were trying to move toward a more unencumbered portfolio, that trend really slowed down in the past few years. So most of the ABS deals that you would have seen in the market were really not for financing, but for sales of pools of aircraft, or they were done for financing for big aviation funds, let's say the Castle Lakes and the Carlyles of the world. But in terms of like an airline trying to do a financing of their own an aircraft leasing company to be able to want to do an financing of their own aircraft, it was really just done by very small leasing companies. Now I want to talk about if you look at the the box to the top right box, airline secured loans and leases. So the trend for this kind of product became very popular, I would say, in the past few years. This is really mostly a private market type of financing, because the private investors took a major interest in aviation, clearly, for obvious reasons, because it provided very good yield for them. And at the same time, they could do a little bit more bespoke transactions. These transactions, actually, we have rated many of them, around 70 odd of them in the private markets since 2013. And essentially what they do is that you may have, just to give an example, you may have a private investor who wants to have exposure to an airline. So they may invest in a transaction that's backed by, let's say, 3 or 4 aircraft to a known airline or 2 airlines. And the rating of those transactions are directly linked to the rating of those airlines. Not as much as, so WTCs, for example, they try to delink the airline rating from the transaction. Here, the ratings of the deals are a lot closer to the airline rating, because you cannot achieve as good an outcome in terms of strategic value of those assets for an airline. So what we call these leaseback transactions, because in most cases, the airline itself doesn't have a guarantee on those transactions, and they're not deemed to be recourse to the airline. They're deemed to be non-recourse, even though they're not ABS transactions. They're corporate transactions, but the leases, essentially, because leases in the aircraft market are hell or high water, are very good substitutes for the rating of the airline. So with that said, I just want to give an example because it makes it a little bit clear to understand. Let's say an airline that's rated BB is doing one of these kinds of transactions. And it's not actually usually the airline, it's usually a financier who would put this type of deal together. Let's say there are 3 aircraft to a BB rated transaction. BB rated airline. So the way you achieve rating for this, the BB rating, because it represents the hell or high water leases, and that meaning that it's very difficult to get out of such leases. Therefore, it's a credit substitute for that BB. So you start with the BB rating, and then you can give credit for the collateral, which that means like if you have a 50% loan to value on that aircraft, because you have cushion of 50% in the value of the aircraft, you can get uplift from that BB. Now, how many notches of uplift you may get, it all depends on some of the other structural features and the LTV, the type of the aircraft, the terms of the transaction, and many other things. For example, a liquidity facility or a PIK facility. But just to say that it's harder to achieve multiple notches of uplift for such transactions. Go back down again to the leasing company secured facilities box. So there too, if just to kind of give some color on the ratings part of it, if you have a, let's say you have a leasing company that's rated BBB. If they do a senior unsecured debt, that rating is very most likely just BBB. But if they do a secured debt, they could get 1 to 2 notches of uplift so that they could do, for example, an A- transaction that's backed by really good aircraft. In very rare cases, they may get 3 notches of uplift, but in most cases, 1 to 2 notches of uplift. I just wanted to put that out so that you can understand how the benefits for collateral come into play in this market. The other thing too, before I go to the intangible asset financing, which is the box in the middle below at the lower center, I'm going to talk a little bit about the corporate ratings of lessors and airlines. So in the lessor space, the corporate rating is very relevant because, as I said, they rate a lot of senior unsecured, they issue a lot of senior unsecured debt. Therefore, the rating of their corporate, it directly links to those ratings. The rating of the bonds are directly related to the rating of the corporate. On the airline market, it's not as common to do senior unsecured rating. And the reason for that being is that most airlines are not rated investment grade. And actually now there are even less of them that are rated investment grade because of the COVID crisis. And this has been it's such an unprecedented hit to the airline markets that many of them have been downgraded from investment grade if they were to begin with. So you usually see airlines with a strong investment grade rating who may go to market to do senior unsecured rating. What airlines do normally is that either they access the WTC market or the airline secured loans and leases that I mentioned. We call them leaseback deals, which are really done in the private market, or they go to banks, which have a very big presence in this market, especially outside of the US, where I think there's less disintermediation from banks. In the US, the capital markets are very strong, but in the rest of the US, it's really not so. And banks actually are a big competitor to the capital markets globally, but especially outside of the US, because they have more money and they can give better terms, and they can also do a package transaction with an airline, where a single capital market financing clearly doesn't have that benefit to it. But before the crisis, I would say that the trend in disintermediation had picked up. It remains to be seen what happens after the crisis, but I think that it's one of those trends that has a momentum for picking up once we're out of the crisis, because capital markets tend to be very efficient, and there is a lot of investor money that's hungry for yield. And this market, because you usually have exposure to fixed rate long-term leases, are particularly attractive for investors. So the more investors take an interest in this market, the stronger capital market presence will become. With that, let's go to the intangible asset financing, which is a very interesting part of financing for airlines. And I would say it's become more prominent recently, especially after COVID. So what is that? They could be airline mileage platforms, because these, especially for big airlines, their miles programs have been very, very strong. These kinds of miles programs, whether they're independently owned or part of the airline group, they have very strong cash flow for airlines. The reason for that being is that they require very little capital expenditure versus like aircraft that would be a very high capital intensive business. They're really like technology firms, these miles programs, yet they create quite a bit of cash flow for airlines. And recently, many airlines have used those because they didn't have, especially those who didn't have a lot of unencumbered assets, they've been able to use these miles programs very successfully in the capital markets with banks and even with the care packages of governments to issue debt against them. They're pretty complicated programs, so I'm not going to go into how you rate them because they're pretty, it's going to take its own presentation to talk about it. But just to broadly say is that you can assign a loan to value based on the enterprise value of these programs, which itself is imputed from the strength of the cash flow from those companies. These are cash flow companies, right? Because they generate cash. So the way to value them is by looking at a future flow of their EBITDA essentially, or cash flow. So their loan to value would be really a loan to enterprise value, let's say, which itself is a multiple of yearly cash flow. So, there are companies that value these kinds of programs, and because they've done really, really well and they've supported, in some cases, even before the crisis, some airlines were able to sell these programs for profit and create quite a bit of cash flow for themselves when they needed it. So, and investors have become a lot more familiar with them because they're a little bit complicated to understand at first. But, we're probably going to see more of them. You may have seen a United deal that was done publicly several weeks ago, which was done very successfully with a very low rate, and it was oversubscribed by multiple times. Another kind of intangible financing, which is really interesting, are financings that are backed by slots, gates, and other intangibles. So what are they? As you know, airlines have access to slots. They don't own them, and that's why they are intangible to slots and gates. But these are pretty valuable in certain airports, especially. These are very valuable intangible assets because they don't directly own them, but they have the right to use them. And in many jurisdictions, these slots have their own type of liquidity, meaning that if you are an airline, you're not using your slots and gates, you can actually transfer it to another airline for a certain amount of money. And there is actually, this happened before, and there are certain airlines in Europe, especially, who've used this as a source of cash flow for themselves. So clearly people know about that, and now post-crisis, some airlines have been using their access to strong slots and gates, and by that meaning that these have to be slots that are in demand. So they tend to be in airports where you have a dearth of slots that are available, let's say. Let's say like in airports like Heathrow, like Gatwick. These are because they have pretty limited space, so their slots are very, very valuable. And there are some also airports in the US which are like that. So that's another form of financing you can do. And again, the valuation is based on some history of liquidity and how much you can liquidate these group of slots and gates for. And then there's a loan to value that's attached to that, which would be, inverse of which, meaning the coverage of which, the extra value to the loan is what supports those transactions. So let's now move. Before I move on, though, I did mention that we have 6 public corporate ratings of lessors because they keep consolidating, and we have a few private ones too. And we have we look at actually 300 to 400 airlines at Kroll, but so far we only have 1 public airline ratings, and that's Hawaiian, which I can talk about. They just did a WTC that we rated a few weeks ago that you may have, you have access to our website, which is free, and you can find the reports on that if you like. We do have, like I said, we follow a lot of airlines in the world because not only we use those credits as a backup for our secured loans and lease ratings, but we also help our ABS team because the initial leases that go into ABS transactions we need to have a credit view on which airlines those are. Now let's go to the next slide, where I'm going to start talking about the summary of rating steps. So I did talk about, so this is slide that starts with airline ratings. I hope you're all there. So, I went into some high-level details on how we might rate these transactions. Now let's break it into parts. So let's look at airline ratings first. So Just so you know, we have a rating methodology that's also posted publicly, and you can see how we approach our airline ratings. But just broadly, there are qualitative steps that have to be followed and quantitative steps. So on the qualitative parts, the first thing we look at are strategy and competitive risk, which actually accounts for 20% of the ratings. These have to do with what kind of business model an airline has. Is it the low-cost carrier? Is it a major carrier? Is it full service? Is it just like partially full service? Maybe they are a seasonal carrier, or maybe they're a charter, or perhaps even they're a cargo airline. And that's really important to understand before we're going to look at what the revenue drivers are, because revenue drivers could be very different from depending on your business model clearly. So if you have an LCC, it's very clear that your revenue drivers are by volume, because you want to fill out your airplanes with low-cost tickets, and that usually tells you what your revenue driver is. And of course, you're also low cost. You try to maintain very low costs in terms of your operating costs, the costs of aircraft, and even your financing costs. Those, for example, a good example for the LCCs is that they tend to be leasing their aircraft rather than owning, because it's always more expensive to own your aircraft than lease it, even though your lease rates might be a bit higher when you're a low-cost carrier. As I said, cost structure is also very important. We also want to understand what growth strategy the airline has and whether they actually can achieve it. I think, almost every company you meet, they're going to give you a very well thought out growth projection for themselves, but we also do our own research to try to make sure that they have the capacity to get there. Because we could sometimes rate an airline at a higher rating than you would think, even though they may not be very big, because we've done our own analysis together with them and have determined that this airline has pretty good prospects for growth. So that would be one reason that we may give them credit before they even achieve the growth. Fleet age is also another thing that we look at, and there's no one answer for that, because you could have airlines which operate an older fleet, and that's completely okay because that's their business model. They tend to save money that way. They might buy aircraft at a much lower price and then operate them, and that could also work really well when fuel prices are low, which has been the case in the past 2 years, and has gone up and down, but it's a very different environment where the oil prices were at $120 a barrel. I think that then fleet age and older fleet age would not be working well at all. All of that said, I think that it's really important to consider that given a lot of the global attention to carbon emissions and all the ESG factors, I think that there is an expectation from the people of the world and also investors initially, because there is a lot of focus on their part on trying to operate more efficient aircraft, even if oil prices are lower, because there's a lot of, for each airline, there's a lot of focus on carbon emission reductions until 2050. I'm not going to go into detail on that, but part of the fleet age dynamic comes into play there. And what I would like to also say that the COVID crisis also has brought a lot of this into fore than it wasn't before. Like I said before, maybe an airline operating an older fleet, let's say a low-cost carrier, perhaps it would have been okay in terms of credit, but given the market we have with all the aircraft retirements and the expectation of a much smaller fleet versus what we had before the crisis, the focus, I think it's world consensus that the focus is going to be on newer aircraft, smaller aircraft, and more efficient aircraft. So I think that fleet age analysis is going to become even more important going forward. Financial flexibility is, even though it's a financial factor, but here this talks more about flexibility of an airline with respect to what kind of access they might have. So availability and cost of debt financing. Not every airline has access to capital markets, as I mentioned before. Smaller airlines in the world would, they just couldn't go and put a huge deal together and sell it because capital market financing specifically has a limit to it. It's very difficult to go to capital markets and issue like a $20 million deal. And when you're a small airline, maybe that's all you need. And that's when banks come into play. Cost of debt financing is very important because it could be a major cost of operation. And the better your credit is, the better your access is, your relationships in the markets, the better the lower your cost of fund, which can make a huge difference in your operating costs. Encumbered versus unencumbered assets. Traditionally, most airlines encumbered their assets because this is how they finance. They would use their aircraft and their other assets as collateral for financing. So they didn't have a lot of unencumbered assets. And that's become very clear now with COVID because most airlines have had to use almost anything they can in order to try to create liquidity for themselves. And in some cases, when they've had unencumbered aircraft, they've actually chosen to lease back the aircraft that they owned, meaning selling them to a leasing company and then leasing it back, which creates liquidity for them and also takes care of the exposure to residual risk because that moves to the leasing company. The other important factor is capital market access both on the secured and unsecured basis. And as I said before, airlines which are have better credits have more access to unsecured, but most airlines probably would use the secured routes. Fleet capital expenditures, again, a very major source of liquidity. So it's important that they can they can have access to the secured market, so which are usually easier than the unsecured market, but that's how they get access to it. So on foreign exchange and fuel, so fuel costs for airlines traditionally used to be very high. When oil price is very high, around, let's say, 40% of the operating cost. That number has come down clearly because fuel costs are lower. But still, they make up a good portion of, airlines' cost of fuel, operating costs, especially in countries where fuel is going to be more expensive. And again, because most of financing for aircraft is done in the US dollar, if you have foreign exchange, meaning if you're earning your revenues in a non-US dollar currency, you're going to also have foreign exchange exposure, which could also add up to a lot of money in periods when we have volatile exchange markets, which probably this is one of them. Frequent flyer programs, I mentioned to you the value of those miles programs. And then pensions and other employment obligations can also add up to a lot of money. So that's a very important factor we look at for airlines as well. I'm going to speed up a little bit because we only have 20 more minutes or so to go through the presentation. So ownership is also important because publicly listed companies have their own dynamics. Private ownership has their own dynamics, and we don't say one is better than the other because in some cases, private ownership has actually been pretty helpful for airlines because they've been able to raise money by their maybe deep-pocketed investors, where in the public market, they're much more exposed to the vagaries of the public markets, which is not really easy to deal with, and the disclosure requirements are so much higher. And government and sovereign ownership, on the other hand, has been very helpful. And as you've seen during the crisis, that state aid has been very, very important for certain airlines being bailed out, and otherwise they wouldn't have been able to survive, because for one reason or another, those airlines are important to a country, whether it's a flag carrier or not, or whether the country the sovereign has decided that these were systemically important companies within their economic environment, so they supported them. And the quantitative steps, these are not very unusual. Clearly, we look at profitability, cash flow. Cash flow clearly very, very important for airlines, and the profitability very much dependent on these high costs of operations, which mainly come from fuel and other operating costs. So cost cutting for airlines is very key, and this is something that in the past few years airlines have really realized, and many of them were able to delever simply by cutting costs and by being able to compete in markets in a more cost-efficient way. And I think everyone has noticed that in the past few years before COVID, how every aircraft would be fully loaded, nearly 100% load factor, because that was one of the ways they could cut costs, because it would lower the trip cost versus the revenue for one trip much lower. Leverage, clearly very important, because it gives airlines a lot more flexibility when they don't have as much leverage. It lowers their cost of operations in terms of cost of financing. The more debt you have, the more it costs you. So bringing down your leverage is very critical for an airline. Unfortunately, now during COVID, it's not going to be very easy to do that, but that's one of the levers that most airlines really focus on. As I mentioned, liquidity clearly very important, especially when you're going through this short-term crisis in the market, which COVID, we don't know the problems that we don't know whether COVID is that short-term just yet, but if you have short-term shocks to the market, liquidity is very important, because you need to be able to have some unrestricted cash and cash equivalent to be able to pay your bills, essentially, to your lessors, to your OEMs and all of that. So it's very important. And then the EBITDA to interest expense and net rates is also very important, because that's really basically is what it's like an interest coverage metric, where a lot of credit analysts focus on. And it's very important, because for an airline, it's not only about the interest on their cost of financing in capital markets or what loans they might have to airlines, but it's also their rental expenses, which could be even more than that, because they might be the kind of airline that leases their aircraft. Many of their aircraft are leased versus owned. So let's go to the next slide. I'm just conscious of time a little bit. So I just wanted to also talk a little bit broadly about how we rate WTCs. I think I did bring up somewhat about how we rate WTCs, and that's by trying to de-link the rating of the airline from the WTC transaction itself. So the way we do it at Kroll is we first determine, the most important thing is to determine whether the pool of aircraft is strategic to an airline. So let's say we assign a corporate rating to an obligor to an airline. I think I brought an example of BB. Now, if we determine that this, let's say a 10 pool of aircraft WTC is essential to this specific airline that's rated at BB, in our modeling, in order to give it credit, we assume that this airline is actually rated BBB. This is our way of modeling our transactions so that the WTC transaction could have a higher starting point, let's say. I know other rating agencies may use different methods, but I think in the end, we all achieve multiple notches of uplift for WTCs. I'd say, if I may say so myself, I would say that our model is a lot more transparent because you can see exactly how it works. We use loss given default approach to our transactions. That's expected loss analysis, meaning there's a probability of default associated with every transaction, and then there is a severity of loss associated with that PD, and those two multiplied by each other will give you expected loss. So in the case of modeling for something like that, by lowering the PD of this particular airline from a BB to BBB, we've essentially given it credit because the PD is going to be a lot lower. Especially a PD of BBB from BB is quite a bit lower because you go through this inflection point of moving from non-investment grade to investment grade. Then the severity of loss for these transactions is determined by the kind of aircraft you have, the type of stresses we might be applying to them. Are they new aircraft? Are they in demand? Are they very liquid going down for that, the term of these transactions, which can be pretty long, sometimes 10 to 14 years, on average 12. So the loan to value of our aircraft and how it depreciates, which has to do with the type of aircraft it is and how old it is, and what stresses we apply to these kinds of aircraft. And the reason we may apply extra stress to the aircraft is because when we default at transactions in a context of ratings, meaning we always there's a PD associated with every period, because we're saying that there's even the probability of default might be very low, but we have to model it by some probability of default in order to be able to aggregate our losses for the term of the transaction. So without getting too technical, what we do is that we assign a probability of default for the term of the transaction. That probability of default itself has a curve. So that probability of default per period is a group of numbers, which you may actually see on, well, I think in here, you only see the results of it because we have a stressed LTV and then we have an LGD. And then you see the PD and the expected loss. So the PD here is an investment grade PD for that period and has a curve to it. So we've only shown a few periods, 5 periods within that modeling, just to make it simple. And I'm happy to talk about it in detail offline if you like, but just to demonstrate that the expected loss then gets calculated by aggregating all these losses per period. So, so in this case, hard for me to see this, but in this case, the expected loss is around, wait a second. So the expected loss that you see below here in that yellow box, that's basically an aggregation of all those numbers. And that expected loss then gets compared to an expected loss for a bond rating. Let's say that expected loss for the terms of the transaction is, I think I have it in here. Sorry, let me just make this a little bit smaller so I can see it. Sorry. So that expected loss of 0.44, if I'm saying it correctly, has an implied rating of A- for this transaction, which the obligor rating we used at BBB, even though the airline itself may not have been rated BBB, but we gave it credit. So let's say the airline was rated BB. Now the rating of the WTC transaction actually could be A- because of the way the PDs have helped it and the kind of aircraft that was in this particular transaction. I hope that's clear. If not, though, I'm happy to talk about it offline because this part is a little bit technical. It's just difficult to do it in a presentation. Now I want to talk a little bit about secured aircraft ratings too, which in which we use the same model, but here we don't use the triple B perhaps as our starting point, because the rating of the airline may not be triple B. So here the obligor rating is actually double B. So in this case, you don't get as many notches of uplift as you can see in that yellow box, because your starting PD was a little bit higher. So I think it's logical that for this you're not going to get as much of an uplift, and the reasons for it, because this just a standard secured aircraft deal is not going to benefit from all the bells and whistles and the structural enhancements of a WTC. The rating is going to be a lot more linked to the rating of the airline. So this page, this is just, it's really just like I'd say a pictorial demonstration of how this our methodology works, which is posted on our website too, and you have access to it, or we can send it to you. So this one is basically saying that my ratings of WTCs and secured aircraft really move on a continuum, meaning that if I have a secured aircraft rating and I have no structural enhancements for it, my rating of a secured deal will be simply a notching exercise from the rating of the airline. But as you move toward the WTC rating, the ratings of the WTC transaction are continuously more, progressively more de-linked from the rating of the airline. So I'll stop there for this. And I just wanted to talk a little bit also about just, general financing trends, because I want to have enough time for our questions, which I think you will have. So I think that you've seen what's going on, that the entire aviation sector is on a negative outlook nearly by all rating agencies, clearly. So, of all our, we've actually done, you probably won't see this, but we've had a number of downgrades for our airline-backed transactions, but it's not as transparent and as visible because most of them are private. The reason for these downgrades have to do with the huge pressure that airlines are experiencing around the globe, clearly. I think that's well known to everyone. So we had to look at all of our transactions to try to make sure that our ratings are still good, especially because this particular unprecedented situation was really one of our very, very stressed it was one of our very stressed scenarios that we would have looked at in the initial rating. And unfortunately, in some cases wasn't stressful enough, because I think this kind of thing has never happened before, where more than 80% of the aircraft around the world are still on the ground, more or less, depending on where you are. And even if they're not on the ground, unfortunately, some of the aircraft are flying because some governments have required them to fly and provide service for certain routes, even if the aircraft is not full. So that means still losses for the airline. So, we've had to do a lot of reviews of our transactions, honestly, and trying to make sure that our ratings still remain correct. So there have been a number of downgrades, watches, all of that. On the lessor companies, we've only downgraded one leasing company and the reason there was because even though the leasing company's credit metrics were relatively strong, but the liquidity factor, which I mentioned, is both important for airlines and for leasing companies, was really weak for this particular case. And therefore that company was downgraded. The rest of the leasing companies we still have on negative. We're in very close contact with them, and we understand their liquidity is under pressure, and they didn't get government help, clearly. But they have been able to use their strong access to liquidity to be able to actually help their airline customers by being able to accept some deferral of lease payments, which has been really critical for airlines, has not been good for the cash flow of leasing companies, but for limited time they have been able to help their customers. They think it's they also have to, because these are their customers. If they want them to survive, in certain cases selectively they've had to help them. So all that to say that the rating of leasing companies are still higher than airlines by quite a bit, and that again has to do with their much stronger balance sheets. Now here, this is just, I just want to talk a little bit about the different sources of financing that we have for airlines. As you see, you have, I think I mentioned this before, there have been many different types of financing, whether it's been capital markets, cash, loans, even, access to insurance companies, export credit, bank debt. And, we've tried to, this is, of course, 2019 numbers, because we still don't know how 2020 is going to shape up, and it will look very different from this, I would imagine. But these are the breakdowns, and they have changed, as you can see, and a lot of it has to do with disintermediation of bank debt, as you see, it's been progressively going down, at least since 2017. Then we also have a little bit of, I have a little bit of, a chart to the right too about airline debt levels entering 2021. As you can see, you're going to have a very hard time deleveraging, because clearly airlines in this market have had to lever up even more than they were before in order to be able to survive this crisis. And we still don't know when it's going to end. So I think the picture is still not clear moving forward. But we do know that most companies and most, economists and aviation economists especially are predicting that we're not going to go back to a normalized market, at least until 2023 or 2024. And even that's changing all the time, depending on whether there's a vaccine found, and whether we can go back to levels where people could travel without fear. On the next slide, I think that, I'm just, this, I think I've spoken about this already, but it's just talking about how the sources of financing may, differ depending on who you are, what kind of need to finance, what kind of access you need to financing, and whether you can afford it or not. As I said, leasing companies have much better access than airlines normally do. So let's look at, I just want to make sure that we're not running out of sorry, I'm not able to go back at one slide. If you can help me, yes. No, maybe I just want to go back to the last one. Okay. So here, this is, of course, a little bit more relevant for before COVID, but I think that it's a more long-term trend, that these aviation assets are very attractive, and they remain very attractive to investors because they provide, they're a depreciating asset, so they provide tax benefits to balance other investments, especially for large insurance companies. There is a strong invested appetite from US and Japanese more recently, but also all over the world, because these, as I said, these assets provide a very good source of fixed income for a long term. So it's, it's the kind of income that portfolio managers like, because they can count on it for a long period of time. traditionally in Europe and outside of the US, the investors were really just banks. But I think that large pension funds, insurance companies have become very, very interested. And then one thing that's really interesting to just say about what's going on during the COVID crisis is that you're also seeing a lot more interest from private investors who do the homework essentially on these more complex transactions that are in the market, such as what I said about intangible debt financings or airlines, which may have value, but it's not clear to your everyday investor because you have this environment where airlines are not even flying their aircraft, but some investors know that some names are better off than others, so they may take that initial risk, and they've been able to invest in very high yielding transactions that they think they're going to prepay in 2 years. So that's been helpful for the airlines and particularly attractive for some investors because they have make-whole provisions for these transactions so that within 2 years they can prepay and make whole the investors, which also is helpful for airlines because they know that they will not have to be subject to this very high cost of financing for the long term. Outside of the US, I think that Asia had become very, very big in the aviation market. Before they had their own, a lot of the Chinese crisis, and then, of course, followed by COVID. So some of that had moved from Chinese investors to Japanese investors. You see a big comeback of Japanese investors to the market, which is really interesting, whether it's by using JOLCOs or buying outright platforms of various leasing companies and taking, even shares of some airlines around the world through other funds and investments that they have, which has actually been really helpful, and it's created some liquidity hole that we've started feeling a little bit about from Chinese investors backing out. Korean investors also very big, of course, in terms of quantum. They're not as big as China and Japan, but they're also quite interested in these assets. And as I said, insurance companies are joining the ranks too, especially before the crisis, with doing more, not just like insuring one transaction, but by banding together with certain, I think you may have seen certain financings that were done by these groups of insurance companies that would share the risk of a particular default, for example, of an airline. I think Balthazar, and there are other ones that I'm sure you've seen in the market. Boeing has their own. We don't know how active they're going to be going forward, but that also was the kind of financing that had replaced the Exim banks and the export credit types of financing, which was pretty helpful. These are really small parts of the market, so I don't want to go into it too much, but it was also another form of financing that became very popular. So it's with that, I think I'll stop because Nils, I think that we have a lot of questions that have come from the audience and we'd like to be able to answer.
Yes, we have some questions. So thank you so much, Arjan, for this. The first question that came in is from Keith Downey. I think he's with Standard Charters in Ireland. He's referring to your comment that the lessors have really moved away from the secured to the unsecured debt markets. Do you think that will be regrettable for some lessors and that their financing cost may increase?
No, I actually think that this has been very critical for them because they had the access to liquidity because they had largely unencumbered assets. And now they have the capability to go to market and, secure some of the unencumbered assets that they had on their balance sheet. So granted, yes, secured deals usually have a higher cost of financing, as I mentioned. And yes, today, if they go to market, they're going to pay a higher price to do a secured deal versus unsecured. Well, no, that's not actually true. They will still pay a lower cost probably versus unsecured. But in the past, I think what they did is that by moving their credit metrics to strong enough credit so that they could go to markets with investment grade type of financing for unsecured credit, they were able to save money big time, I would say, because it was by volume that they were saving so much money by doing large unsecured transactions than by just the difference between the spread between secured and unsecured. So no, I would say it actually has been very helpful for them.
Okay. Then there is one question we have from actually two people. One is from Pio Liang Yan, and the other one is from Sander, professor at Embry-Riddle in Florida. So with the changes in lease accounting, with the IFRS 16, does that change your credit analysis of the airlines?
Well, no, not ours, because we always did what we needed to do to recognize leases at debt, and I think that I mentioned it a little bit on the slides for airline ratings. I think that and I think that most credit analysts on Wall Street did that already. This is more an accounting issue, and it does make a difference in how the financial statements are being presented, but not from credit analyst point of view, we always consider them as debt.
Thank you. So, Marjan, when you discussed the airline corporate ratings, you mentioned that the ownership accounted for 10% of the weight in the overall rating algorithm. Now, do you think that because of this pandemic now, that if you have sizable ownership by the government of the country, does that have more importance than the 10% that is assigned in the weight?
Yeah, I mean, those percentages that are in our rating methodology, first of all, they're just, I'd say they're tools, because it also depends on who you are and in what, airlines around the world, they're in very different jurisdictions, both from an economic perspective, but also in terms of like a small country's flag carrier may be much, much more important to them than a larger country's flag carrier. And as you know, in the US, for example, we don't have the concept of flag carriers. We just have large systemically important airlines, which clearly are benefiting from some government help. And, as you know, we're waiting for the end of September to see if there's another round coming. So yes, I mean, I would say, if I just put it in more simple terms, that if I have a strong government owning, let's say 60% of an airline, that makes a difference. But if the government rating itself is not that strong, it may not really make a difference. And I think that in each case, it's really it's like a case-by-case analysis. Why? Because you also have to understand how important an airline is to a sovereign, whether they own it or not. Sometimes it's a matter of pride, other times it's not. Some countries are more sophisticated in terms of their access to lease financing down the road, their access to markets. So, some countries, some flag carriers, for example, or non-flag carriers, they may have done WTCs in the past outside of the US. And I think maybe the Latin American WTC is an interesting example to bring up, because you would think that when LATAM would reject their WTCs, you would think that, did they think twice about their access to capital markets going forward? And, there are many answers to that, maybe because they were never a big WTC issuer. And sometimes they do these things because it brings the creditors to the table much easier. There are a lot of complex negotiations go around when you're doing a restructuring. That's really difficult to answer it in one go. But I would say that those percentages could also change from one rating to another depending on what circumstances you have. So sometimes it might be 10%, other times it might be 15%.
But do you think that this rejection of the aircraft in the LATAM WTC will make Kroll have to revise their thinking about how the strategicness of the aircraft in that WTC will impact the rating that you can
well, it
attach to the
certainly
issue?
made us notice. Let's say it was a kind of an unprecedented event, and we're doing a lot of research into it. I think that it's I can't say for sure, of course, but it's conceivable that a U.S. airline would do that. I think it all has to do with how much you need that market for yourself. Whatever the reasons were for LATAM to do that, it made them do it, and clearly they were not so worried about it because they did it. And we still don't know how that's going to pan out. In any case, I think it may have also been a negotiating tactic, which happens. One thing that I've learned about WTCs, because I've been involved in a number of restructurings, is that each case is different, and that you can't just simply look at the legal framework that's allowed under 1110 or Cape Town, because in the end, the bankruptcy trustee or the debtor in possession has total control. And in the end, they will try to see what's the best outcome. And that's not always very clear. But I would say in markets like the US, where WTCs were a very, very important form of financing, and it's a vibrant investor market for them, I think that a US airline would think twice before doing something like that.
Right. Andreas Nyman from Kuehne+Nagel in Norway is asking, given the unprecedented situation in today's market, is there an increase of the frequency of the rating reviews that you do, and have any of those findings been surprising to you?
Absolutely. Yes, I think I did mention that. Just to kind of lay out the process, we review our ratings once a year, no matter what. With respect to U.S. airlines, for example, because you have quarterly results coming in, if you see something, we follow our credits on a daily basis. Let's say we may not take rating actions or do formal reviews, but we follow our credits very closely. And clearly, when you're in an environment like this, as I mentioned, we've been doing a lot of reviews, and a number of downgrades and watches have been done both for our public ratings and our private ratings. So yes, I think that when you're in a crisis, you better do that. It's very important because we want to make sure our ratings are correct.
Marianne, you mentioned that your expectation is that the airlines will increase their debt burden by about $120 billion this year, so going up from 430 to 550. Now, this is an increased burden of about 30%. Is that something that will, you think, impact the ratings for the airlines? Because you said in one slide that you're looking at the longer term, the post-COVID situation a little bit. But still, that very heavy debt burden, that is going to be there even after the pandemic is gone.
That's actually a very good point. So that's what it's about. One of the things we do at Kroll, we try to not be too, we don't want to have too much rating variability. We do try to take a more forward-looking approach. But this environment actually is very interesting because you see that it's going to be with us for a while. Therefore, if you're levering up and you're moving into an environment which is going to be much harder to make money, you would think that, going forward, you're going to be levered up a lot more, and therefore your rating is going to be lower. I think that's pretty obvious, yeah. I think that ratings have affected and they will be affected. Of course, we look at each name separately because not every airline is in the same boat, even though everybody is under pressure. But there's some airlines who were already highly levered and now they're going to be even more levered. There were others who weren't and now they're still more levered. But, we might see a stronger airline going forward. And then, we're also following airlines very closely. As I said, we see an environment where you're going to have much smaller global fleets for a while. And it remains to be seen which it doesn't even remain to be seen. There are some airlines which are going to be winners and those who are going to be losers. And some of the losers you've already seen. We've had many, many bankruptcies already. And so you might appear with later on have an environment of less airlines, but stronger airlines. And, once the round of state aids stop also, it could be that we'll see an environment where there's huge cost cuts because now many airlines are able to, unfortunately, furlough and cut a lot of employment, which is really unfortunate for those who work at these airlines, but it can really help them with cash flow and cost efficiency. You're going to have a very different environment going forward.
Okay.
What aircraft? I think one of the things that was in the list of things we talked about was aircraft age. I think that airlines who have newer aircraft are going to be better off on many levels because we don't have as many, older aircraft are being retired. You want more efficient aircraft. You don't want as many wide bodies because international travel is going to be under more pressure than even domestic, even now, and for at least the near future. So, the fleet makeup is going to be different too.
Ajahn, thank you so much for this, and thank you everybody for dialing in. And don't forget to come back and see us on the 25th of September with Shannon Ackert. Thank you, guys.
All right. Thank you.